Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Steve Sosnick, chief strategist at Interactive Brokers, to kind of help us make sense of what's happening in the market. Steve, it's great to see you as always, the first Friday of the month, and the trading activity has been pretty interesting. It seems to be, we'll look at jobs data first. Good news is bad news, and sometimes not so bad news can be good news.
Oh yeah, well, great to see you as always, Jill. That I think you sums it up very well. We got in the mindset of bad news was good news because remember, ultimately, stock traders, at least the past few years, have more or less been liquidity addicts. If the Fed can give them the liquidity that they're seeking, that's taken as a reason to buy the market. Well, stock traders loved Powell's comment about neutral, even though at the time, and we wrote this, it seemed as though he was going to get a lot of pushback, and he did. The bond market reacted to the pushback. Basically, yields went right back to where they were before the Fed meeting, and looking at 2-year yields, for example, stocks didn't really seem to follow the lead from the bond market, even as the Fed governors pushed back. Today, we have a number that really biases us against the Fed doing anything but keeping their, really pressing the brakes hard about interest rate hikes or not weakening their resolve about QT, which has really just started quantitative tightening. And so stocks are acting. I would have expected a weaker result, if we were following the bond market, but we're following the economy or looking for Fed, some easing from the Fed, some easing, so a lighter tap on the brakes, as it were. But realistically, stocks are holding in rather well. So yeah, bad news is good news, I guess. And we had good news on the earnings front. That was good news. The stock traders are in a happy mood right now.
Yeah, I mean, we saw that through earnings season, to your point. I mean, we're kind of on the back end of it now, but it was, if they did not come in as bad as expected, we saw stocks get rewarded. I wonder if it's a function of the market looking for some clarity, and we saw that management teams were starting to adjust their strategies more in line with what we're seeing in the economy, whether it's hiring freezes or cutting back on their employee headcount, or perhaps readjusting their growth and CapEx spend for next year. It seems as if the market digested it as, all right, now we know what we're supposed to do in terms of the economy, and that Band-Aid came off.
Well, yeah, I think to your point, the traders were looking for something worse. Think about how poorly we reacted, to fourth quarter. To fourth quarter of last year numbers, January earnings season. It's easier if I just speak in terms of months. January earnings season, we punished some big names like Netflix. April earnings season, we were merciless, in terms of what we did to Amazon, Meta, Netflix once again. So I think having seen the lows in June, well, whether or not they remain permanent lows, we'll address that another time. But having seen, sort of the carnage that the market had experienced through June, I think traders' perceptions had gotten so negative that, that as long as the numbers weren't bad, and in some cases the numbers weren't great, but it was good enough to rally off of, we were going to see a positive reaction in earnings season. And that to me was the big, was really a tell, was how we would, not so much what the numbers would be, but how we would react to disappointment and how we would reward success. Although I think banks set a lousy tone for earnings season most quarters. I think the reactions of JP Morgan, which was modest to a decline, and Citigroup, which was fabulous to a beat, set the tone. And particularly last week when we had the Nasdaq mega caps come out, not all of them were great results, but they were all good enough. And these are the stocks that investors love them. They wouldn't have these market caps if investors didn't. And there was nothing in those numbers to disrupt the investment thesis in the biggest names. And that really set the tone since then.
And Steve, let me ask you about HKD, right? This is a name that was trading double digits, went over 1,000, went over 2,000, kind of, coming back down to earth here. How does that happen in the span of a week? What happened there? I mean, is it a meme stock?
It's not a meme stock because I don't think it really captured, the general imagination. My definition of a meme stock was that there was some nostalgic element to it, by the traders who were most heavily in love with these names. Think about it: GameStop, AMC, Build-A-Bear. These are the things that the millennials who are coming of age in the market, so to speak, would see in the mall when they were kids, and they didn't really want to see these stocks go out of business, and so they took a real shine to them and really felt the need to punish the shorts. Well, the idea of exploiting short sales certainly hasn't gone away. It's been it's been there since as long as short sales existed. This is something quite unusual. It's very hard to put my finger on. The float is very small. It was okay that the stocks rallied shortly after their IPO. That was maybe okay, but it's not clear this company has much of a business. I think the revenues were like $25 million or something like that. So something else is going on. And it doesn't seem to be that sort of popular groundswell. At least initially, it wasn't that popular groundswell that we saw in the meme stock raise. This seems a bit more targeted. I can't put my finger on it. I certainly don't want to cast aspersions in a public setting like this, but something stinks.
Yeah.
But what it does show us is that speculative fever has not gone away. And for those of us who are looking for the capitulation, I don't think we've seen it yet. You couldn't have moves of this type when you haven't had capitulation. The interesting thing here is it's a subsidiary. HKD is a subsidiary of AMTD, not to be confused with TD Ameritrade, which had that symbol for decades. But the subsidiary is much larger than the parent, which would normally be something you would try to that arbitrageurs would try to hammer out by selling the subsidiary and buying the parent. Obviously, the parent shouldn't be worth less than the subsidiary. But when you have dysfunctional small floats and dysfunctional markets, the rate quote I got on HKD to short today was negative 1,500. Okay, that is like mind-boggling. And so as a result, and that is, so even if you could guarantee that you could keep your short on, which there's no guarantees in a float that small, you can't really try to arbitrage this out. So it's going to remain this pocket of irrationality for as long as it persists. And, these irrational situations, usually come to an end, but we all know that markets can be irrational longer than you and I can remain solvent. And so here we are.
Yes. All right, Steve, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.